Michael Lee, founder, Michael Lee Strategy. I see what you're saying, Michael Lee. Explain to the folks why you think this is a good strategy. Buy like the Fed does.
So what the Fed has done here is nothing short of remarkable. And it's not only the Fed, it's the Treasury Department. So the Treasury Department has created special purpose vehicles, and these special purpose vehicles can be funded with some capital from the U.S. Treasury, and then allows the Fed to go out and do things that they're not allowed to by charter. So when I talk to other people in the industry that run money, whether they're large or small on the retail or institutional side, we're all in consensus that this equity market is completely disconnected from the fundamentals. And so at first you think it was a short covering rally, a relief rally, and we're going to see some sort of double bottom. I would like to see that. I don't know that we necessarily will, and here's why. What the Fed has done is come in here with several different programs. The first, which is they return to, which is buying U.S. Treasury bonds. So when the Fed buys $100 billion of Treasury bonds, that creates $100 billion of balance sheet liquidity for the largest banks in the world, as well as the largest broker-dealers and asset managers, allowing the banks to lend out more money, as well as buy more risk assets. Okay, the next thing the Fed did is they opened their window to post collateral to non-financial institutions. So companies that aren't banks can go up to the Fed window, post their treasuries, their agencies, their stocks, their junk bonds to the Federal Reserve and get liquidity against that. That's never happened before. The next thing the Fed did was they opened a commercial paper program, allowing short-term lending facilities to anybody that's either investment grade or was investment grade prior to the crisis happening. These, when you combine all these things, you flooded a tremendous amount of liquidity in the market. And well, that just seems like it's paper in the background and it's kind of accounting. What it does is it's going to create a V-shaped recovery to some degree. Okay, what do I mean by that? I mean, when you look at a typical historical business cycle, at the bottom of the business cycle, you see a lot of bankruptcies. And why would a company go bankrupt? Because they run out of cash, they run out of liquidity. It becomes too difficult for them to tap into the capital markets or borrow money from the bank. The Fed has taken that option off the table for thousands of companies, meaning we've already seen a dramatic amount of job loss, but it's nowhere near as bad as it could have been had the Fed not stepped in. And a lot of people are furloughed right now. So when the economy opens, you're going to see some form of a snapback that would not be the case without the Fed stepping in and creating this liquidity. And so the final thing that the Fed is doing, which I'll tie it all in, is they're going to start buying corporate bonds via the ETF LQD. So that is a corporate bond ETF that the Fed is going to outright buy, so that borrowing costs for large investment grade companies don't get out of hand, allowing them to maintain operations, reopen operations, and run their companies and not go out of business, so that the economy does snap back.
Right, and I know that you had some of the others in there, SJNK, FPE, but I'm also curious, in addition to LQD, which you said that's what the Fed's buying, what about tech? That's always sort of been an area that you like, and now you're sounding a little more positive. You've always been our bull, but, I understand we've gone through a really tumultuous time here. You're sounding a little more positive. Do you like tech now?
Yeah, so what ends up happening is when the Fed pours money in, okay, and as the Fed pours money in to the big banks and all these sort of investment grades, you get a cascading effect to all these other risk assets. So you've already started to see that in preferreds, you've already started to see that in junk. And then on the equity side, you start looking at these companies like Apple and Microsoft with their fortress balance sheets. That these companies are going to win no matter what. They're going to have a few rough quarters, and if anything, in these types of situations, these types of economic slowdowns, these types of economic pullbacks, crush their competitors. The transition to the cloud will be accelerated because of the coronavirus and what we've seen in the economy. And then, people are just going to spend more time on their screens. And then you have a 5G upgrade super cycle coming with Apple. So those two companies are almost better than buying bonds in certain circumstances. So I think you see the spillover effect from treasuries to investment grade, with the Fed is actually buying, to high yield and then in equities. And I think the Fed action one thing I failed to mention before was their Main Street lending program. Okay, this is going to have an effect on the real economy. And I think a lot of the economic damage that has been done because of Fed action will be made up for. So say we get to 25% unemployment, we may get back to 12 or 10% in a hurry, which we would not have without the Treasury Department coming up with these special purpose vehicles and Jerome Powell stepping in with not a Fed bazooka. I refer to it as the Fed Moab, the Fed mother of all bombs.
Right, right. All right. Michael Lee, thank you so much. Michael Lee, founder, Michael Lee Strategy. It is great to see you. Thanks a lot.